Oh man, do we have a house full today? Well, thank you guys for joining me today. So, you're trying to figure out, and we'll just go through the number one question I continue to get asked is when are rates going to get back down to 4%? So, today I'm going to just change things around. Folks, I had a tough time getting out of college. I had to have my roommate pass me into the math class to get me through college. So, I'm not a CPA. I'm not going to tell you I'm a CPA. I'm no financial planner. I'm just like you. I'm a mortgage guy. So what I want to help explain to you guys, or I'll give you the data, because I'm not going to come out here and say, okay, this is exactly what's going to happen. I don't know. I'm not going to be like people that, said the Bitcoin's going to hit 1 million or go to zero. They were wrong. Housing crash. They were wrong. So let's make you the economist today. So when we're done, and here's what I need to do. Based on the information we figure out, if you think it's time that right now's the time to refinance, I'll give you my website and we can go over there and put your information in. And if you even think that maybe this is the perfect time to get pre-approved and start looking for that house again, we can go there as well. But I'm going to put you in the driver's seat. So let's figure this out. Okay. So we want to figure out when rates are going to get there. What do you guys think? Are we going to get there? I did a poll the other day and the poll was, and this is why I did it. I'm like, why aren't a lot of people jumping, taking advantage of today's rates in mortgages? And the study I did, it was almost everybody thinks we're going to be at 5.99 by the end of the year and lower rates as they continue. So let me know what you think. But let's dive into the data. I want to give you kind of a backdrop of what happened. We're going to look at history and all these things. Mainly, I'm just going to give you the information. And at the end of this, I want you guys to post where you think rate's going to be the end of this year and then the end of that next year. So then you can, it's easy to armchair quarterback, but I'm going to put you in the seat. So let's get over to it. So first thing I want to do is go over what happened. Okay, so this might be a good day to talk about this. The Federal Reserve is meeting in 5 days. Okay, what are they going to do? They're going to cut. Okay, but we have huge information coming out tomorrow. But here's the reason why I'm doing this today. Mortgage rates are going up. Here's what's happening to the bond market today. So if you follow me each day, we look at this. This is the mortgage bond. So as the price of this bond goes down, rates go up. Okay, this isn't good news. Rates are going to go up probably a little bit more than they're showing right through there. Okay, what we're waiting for tomorrow. Tomorrow is going to be a huge day. Okay, we're going to get consumer inflation. Now, we don't know what these numbers are going to look like because we've been in a black hole over the last couple of weeks. So how's this number going to come in? Hot? Cold? Where's it going to be? So let's go down and dig into the data we want to look at today. So folks, let me know if you can hear me. I always want to know if my audio is coming through and you can see me okay. But let's figure this out. Hey, we got Hoover on with us. Let me know where you guys are coming from. We got anybody here from New York? We want them from New York to California. So what do we got? Let's go over to one question. Probably if you buy it down, I think we make it in the low fives. 4 could happen if we're lucky. Lucky? Let's take the luck out of it. Let's get over to the details we want to look at. Now, the first thing we're seeing on your screen is this is where mortgage rates have been over the last 30 years. Okay. So we put the trend line down through here, and this is 4%. Okay. And again, the reason why I'm talking to people now is it might be an entry point. Are they going to keep going lower? If they are, just wait. Wait for the refinance, wait for the spring season. But we don't know. So that's why I'm just trying to protect you here and just give you the information. So the rate we're looking at is 4%. That's the threshold right across here. If you look back in history, how many times have we been there? Is that the norm in the past? Well, it happened briefly here. And then right through here, we had basically it's kind of when this through here to here is the housing debacle. Remember the Great Recession, the housing crash. Okay, and then you got through here, you have COVID. Okay, so if you go pre all this stuff, rates are usually above 5%. I bought my house back in here and it was like 7%. I refinanced, just an FYI. I've refinanced my house 5 times since I've been here, and I've been here for 27 years. I went from here to here. I got 2.6. Okay, so let's dive into the data that puts us here. Here's what happened over history. And if you guys agree with me, thumbs up. If you don't, you're more than welcome to debate me, but I'm just trying to present you the facts. So in the 1990s, rates were about between 6 and 9, huge spread. But Ford, when they said 4 is a unicorn, it wasn't even in the realm of a possibility. Okay, 2000, 2007, we had that's the tech bubble. Remember the 2000 bubble? You guys might not even been alive, but there was a tech bubble back at then. The government stepped in, and I'm going to show you what they did and how this is affecting everybody, the budget, the deficits, our inflation rates, and everything. But right through here, what they did is they dropped rates and they got it down to 5s and 6 range. That was low. And then QE happened in 2010. QE means quantitative easing. And I'm going to go over that with you because last week, the Federal Reserve came in, the Federal Reserve chair, and said, we're going to start or stop quantitative tightening. Well, this says quantitative easing. So what happened at that time was the Federal Reserve came in and they bought up the bond market and artificially dropped rates down into the 3s and 4s. We had that in 2010 just to save the housing market. So an anomaly, it was a worldwide event with housing. It was terrible. Okay, so the Fed stepped in and helped. Okay, and then 2020, 2021, the pandemic hit. Okay, so let's just fast forward over there real quick. Okay, so here's our national debt. Okay, this was 35 trillion, then it went to 36. It hit 37 or 38 pretty darn quick. Okay, so but here's the Federal Reserve's balance sheet. Here's what happened. You can see over those time periods in 2020 when the whole world shut down, the Fed just printed money like crazy. And they bought up the mortgage market. They bought up the bond market, pushing rates to the lowest level we've ever seen in history. Don't believe me? Just chat GPT me or AI me. So this is what we saw. This is what is called quantitative easing. What they're doing is they're buying up the markets, sending money out to people and doing a whole bunch of things. And I had a point during this time frame, I'm like, this is going to be really bad because this is going to cause inflation. And everybody's like, no, we need this. Well, here's what happened. Here's consumer disposable income. And I'm getting to a point because we have to wrap all this stuff around to figure out where a rate's going to go. So this is our consumer disposable income. If you go back all the way to 1960, I was born in 65. Yeah, I'm an old fella. But in 1960, people started saving money. My dad would put $1 away per paycheck. And then, things got a little better. I got a job in the 80s and 90s, and I was trying to save and make a better life for me and my family. And people, they just started saving a little bit more, and people got a little more educated. All of a sudden, boom. What is that anomaly? What is that? This is disposable income. How much money people have in their pocket? What is that spike? Well, it was from 2020 to 2021, 22. COVID. So what happened was the Fed, the government just pumped out the government. The government has no money. Okay, that's why we're here. The Federal Reserve pumped out billions and trillions of dollars. Look, we went from 4 trillion to say 8 trillion pretty darn quick. It's a lot of money. Okay, so that's what happened. We have all this money. All the consumers have this money. What do you do with it? We're not a saving country because we spent it all. And we got back down to the same levels down through here, and then we just got back on our patterns. Where'd all this money go? We spent it. That's inflation. That's what kicked up all this stuff. And I've been predicting it for years. And everybody kept saying, no, we're not going to. No, people need it. They can't survive without it. Well, that's what happened. Okay, so then here's what this is the 30-year fixed rate average. Again, you could see over time back here in the 80s, 17, 18%. You guys are complaining. I know housing prices are expensive, but you imagine an 18% interest rate? It's pretty crazy. Okay, so that's kind of the backdrop. Let's get back and figure out, okay, where's it going to go from here? And please let me know, where do you think rates are going to be by the end of the year? Do you think, you can even just give me a thumbs up or thumbs down if you would. Do you think we're going to be in the below 6? I'll say 5.99 can even make it. I want to see if you guys are thinking we're going to get there in 2025 or maybe by the end of this year, and when you guys think we're going to get there, because if you're on the channel, that's what we're trying to figure out. So let's get over to the takeaways of this. Here's what happened here, and we just showed you. Okay, you go over to this part. What would bring us to 4s? Okay, so if you go through here, inflation drifting below 2. It's not going to drift below 2. I'd love to hear your comments on there. Do you think we're going to get the inflation rate below 2? We're hoping that we can stay below 3. Okay, so I don't think this is coming anytime soon. So that means cooling inflation. I don't think that's there. Fed cuts. Tighter term premiums. Fed's cutting. We know the Fed's cutting. If you go to the Fed, where is it? The Fed Watch tool in 5 days. What are they going to do? Well, you go to the CME Fed Watch tool. You can go over to it. And here's the probabilities right through here. Okay, there's a 99% chance Federal Reserve is going to cut at this meeting. Then there's a 92% chance they're going to cut at the next meeting. But what happened over the last few meetings? Well, whatever happened in the last 2 years. Every September, for some reason, the Federal Reserve cut, And then right after that, mortgage rates jumped. And we're kind of seeing that a little bit right now. We have the MBS market up or down 20 points. That's gonna push up rates. Where are we? So let's refresh this and see if we got that. So if you guys would, let me know where you think the rates are going to go from there. So let's keep diving into this. The next thing is slower growth without credit stress. Well, we have growth right now that I'm scratching my head because Blackstone was on this morning. They said they're seeing the GDP at about 3.8, and they're hoping it rises even higher. So then you have a lower factor. What a lot of people look at is what our deficit is versus our GDP, and there's a factor. And they're like, well, if we can get the GDP up, even with the deficit we have right now, that's going to help things. So that's the talks there. And then the tariffs are going to be another thing we'll talk about here in a second. Less Treasury supply. Okay, so here's the Treasury supply. Okay, so when the federal government has no money, which is the national debt up there, they have to issue the Treasury bonds or Treasury bills. And so I don't think they're going to stop anytime soon, even with tariffs. So tariffs brought in, I just quoted it over here, like $30 billion, $30 billion this month in tariff money. It's going to probably increase and continue to go from there. So that's going to help our deficit. Okay. But now if we can get the GDP up, that can also offset those numbers. So that's what we're focusing on there. So let's go back to this. And so we now have, what are we looking at? Inflation below 2? No. Fed cuts? Yes. Slower growth? Probably. Less supply? No. Well, none of these point to we're going to get to 4% anytime soon. So let's continue to go down here. What would you do, or what would I do if I was a buyer in this market, well, or a homeowner? Let's look at it. Plan your payments at today's rate. If you're looking at today, or you're looking to buy down the road, focus in on, don't try to qualify at 599. A lot of people, when they were building their homes back in 2020, 2019, we had a lot of people that were in the process of building. By the time they started the project and by the time they ended, rates went from like 4 to 8. They couldn't afford the house. So right now, we're not in that environment. If you're looking to buy or build, I would at least look at, maybe 6.5 or 6, especially if you're looking to buy or build, look at a 6.75 rate to qualify. And you could do that right through here. You go to our website. Let me give you some of the tools that we have here for homeowners and home buyers. So if you're a homeowner and you're trying to track rates to figure out, and at the end of this video, you decide, is now maybe the time to do it, or should you still wait? Either or, we got a tool for you. It's called RateWatch 2.0. What this is, it allow you homeowners plug in your mortgage information and then let me know what interest rate you'd like to at least kick the tires on to see if that would work for you. So let's say you're at 7 now and you're like, Dan, when rates hit 6, reach out to me. So we will. What we're going to do is go over what that new payment would be. Most important, what the costs are going to be, what your break-even point is. If it works, good job. If it doesn't, we'll lower your rate and then contact you when rates get a little bit lower, if they go a little bit lower. If you're a home buyer, check out this right through here. It'll give you up to $7,000 to buy a house. Now, you can even get qualified through us and even ask us questions right through here. Give us a call. Alan's right in the back. He'll take calls right now. You can ask me a question through here, and you can even schedule a consultation. So if you're out there trying to buy, build, refinance, what do you do? So here's my thoughts, and let me know what you guys think. Based on the data we have so far, what it would take to bring down rates below 4% would be basically this. And let's bring up where the rates are today. 4% is a long way from here, folks. Rates usually don't move this much in the matter of a day or two. So we have rates at 6%. That means the market's going to have to just drive these prices down, the rates down. What would it take? Let's recap what we went over. We would take inflation under 2%. Do you think we're going to be there this year? Do you think we'll be there by the end of next year? If not, we're not going to get to 4. Okay. The next thing is, are we going to have less debt? Well, the tariffs are going to play a big role in this. Are tariffs going to be deemed legal or illegal? Right now, they're bringing in $30 billion a month. There was other things that I had on here. I was going to look up to see how much tariff money we used to get in the past, because $30 billion, that's a lot of money each month. And a lot of people are saying that's going to pump up the inflation. It hasn't yet, but is it going to come down the pike? Okay, so when we're focusing in on the 4%, then the next thing, the biggest catalyst, what people miss during all this, is during these times that all this happened, the Federal Reserve was behind it. Okay, so what they did is they pumped up. They went in and they bought up the market. So let me explain this to you real briefly, because I don't want to bore you in the bond market. How bonds work is this way. You see the price of the bond going down right now. Okay. How rates go down is this bond needs to go up. Okay. So the price of a bond, if it goes up, yields come down. Okay. So what happened was during all these pandemics and all these times where we saw interest rates getting to 3, 2, 3, 4%, we had the Federal Reserve coming in. During that time, they were buying $40 billion a month. $40 billion a month to save housing, to save the economy, to save the world. Okay. And that's representative right through here. That's where we went from 4 trillion in debt to 9 trillion in debt. That's what caused it. Okay, right through there. So they bought it. So what they've been doing since then, let's now talk about quantitative tightening. So what the Fed's been doing, even in this shitty market that we have, with rates at sky high levels, and everybody's saying, okay, we can't afford a house payment at 8%. And I get it. But here's what they've been doing. They've been raising rates and quantitative tightening. So what they're doing is now the opposite of when they went in and were buying 40 billion in bonds. Now they're selling bonds into the market. So again, that's going to put more pressure on the bond market. So let's go back over. And it's not a bond lesson, but you have to understand the fundamentals. Okay, so let's say, for example, what happens when rates went down? Well, the Fed jumped in and they just bought up the market, driving the price as high as they can. Now they're selling and selling and selling, kind of like the same thing had happened with housing when the housing market crashed. Way too many houses to be absorbed. What has to happen? House prices or prices on that product have to come down. Well, in this thing, if this comes down, rates go up. So how's this all going to work? So what do you think? Do you think we're going to get to 4% this year? Do you think we'll get to 4% next year? So the question that always comes to me is, Dan, when are those rates going to get down there? So I would just look at it right through here. I would plan if you can get rates in the sub 5s, jump on it. I don't know how long they're going to be around. The next piece of the puzzle is, if you can refinance and the cost, your break-even cost is less than a year old, less than a year might be a good time to do it. We don't know. Don't take advantage or don't take this for granted, because a lot of people, what they did in the past, they didn't take advantage of this. Then rates ran all the way back up and they sat there and kicked themselves in the head. Was that you? So again, go back to our website. Use these tools that we have provided for you for some assistance. So if you guys have any questions that you would love to ask, that's what I'm here for, folks. So let's get over to it. So I hope, let's go back just one second. Let me know what you guys think. If you could please participate. We have a record full of people today, and hopefully you can do this. Let me know, do you think that rates will be below, and I don't even care if they're 5.99, do you think we'll be below 6% December 31st, 2025? That's the first question I got for you. The second question is, do you think we'll be in the 4s based on all the data that we just went over? We can recap it. The Federal Reserve's going to cut. The economic calendar, the thing that scares me for tomorrow, folks, is there's some consumer inflation numbers coming out tomorrow. And the reason why they're doing that is for Social Security recipients. They're going to come in and say, here's what the CPI number is. What this number represents is consumer inflation. They're expecting it, the CPI year over year, to go from 2.9 to 3.1. And that's what we're going to see. That will probably be the headline numbers, and that's what everything's going to be based on. So now that's over 3. Where's the market's going to go? Reference back to this. Go back to the blog that we have on our channel right through here. Check out a lot of the blogs that we have under resources right through here. You can find today's show and other shows that we've done as well. And we also podcast and do things like that. So let's get over to your questions. Hopefully you guys are here. Your homeowners, your home buyers want to understand where rates are going to go from here. Please. I'd like to participation too. So let me know what you guys think. So let's get over to it. First thing we got is you can currently buy a 5.125 with a 30-year fix. Yes, you can. How much? What's it going to cost you? Do you want to? Can they go lower? Are they going to go lower? Here, I'll put you in my shoes. I have a borrower coming in and they're saying, okay, we can get you 5.125 today. And there's going to be a lot of cost with that, with a 30-year, I can guarantee you with that. But I'm just saying, so you get that. But then you sit there and say, well, are they going to go lower? Can they go to 4.99? Should I hold off? It's 5.1. I don't know. Should I wait? That's what I get every day. And that's why everybody keeps coming in. And I get it. Where it's like, are they going to go lower? Are they going to go lower? The unfortunate thing is a lot of people are at 7 and you're giving them 6. They're saving $300, $400, $500 a month, but you keep thinking, are they going to go lower? I don't know. And that's why I have you here. So hopefully if you guys were armchair quarterbacks, join me in this and let me know what you think. Okay, so let's get back to it. Well, we got a lot of questions coming in. So if you bad goat, how much are your costs to buy it down to 5.125? And you got to remember, I have 30 banks rates right on my computer system that I can scan. So it's not cheap to get a 30-year fixed rate at 5.125. I just want to say you're more than welcome to scan everywhere you want to go. 1.25 points. You might want to be careful on that one. So that's all I want to say on that one. Let's get to the next question. Thank you for the information. I'm guessing April will be you're guessing April is 4.75. Prestone. So I hope you're right. I hope you're right. Okay, so let's get to the next one. What do we got here? 4% will only come if Trump pushes the Federal Reserve. Let's go down that a little bit. Even if the Federal Reserve or the Trump comes in and he gets his person at the Federal Reserve helm, I don't think they're going to go crazy. I know he wants lower rates, but just because the Federal Reserve cut rates doesn't mean mortgage rates are going to go lower. So you have to understand what creates or what is the federal funds rate. Okay, the federal funds rate is basically this. It's interbank lending. Federal Reserve, that's the only interest rate the Federal Reserve controls, interbank lending. So when one bank kind of tries to close down for the day. So what happens is, here's the regulations. For a bank to close down, let's say they have to have $1 billion in reserves. Well, they don't. Let's say one day they're short. What they do is they go to another bank, get money lent to them overnight, and they pay the federal funds rate. When that rate goes up, then the bank passes those over to us, and when it goes down, same thing. So it doesn't have anything to do with the bond market, the MBSs, which is mortgage bonds, and the 10-year Treasury. That's dictated from this policies, the Federal Reserve, everything. I just showed you how the Federal Reserve, they're the ones that bought up the market during those times. But this isn't good news, folks. This is creating that bubble that we kind of have right now where I'm not going to move. Like, my rate's 2.6. I mean, it's like free money. So let's go back to some other questions. But kudos. I hope you guys are right. I'm not coming out here to contradict you, saying you're an idiot or whatever. I hope you're right. But I just, if you can let me know where you're seeing that is, I'd love to get that. Which lender is offering that? I'd love to know that too. Credit Union West. Okay. It might be, and again, I don't know anything about that and so forth. So God bless you with all that. Let's see what we got. Really hoping for that investment too. Okay, let's get down to some other ones. I don't know which lender. Okay, Harvey, you were talking back and forth. Is a bought down mortgage rate good for the term? Is a bought down mortgage? Yeah. So let me try to explain that. I think I got your question. There's two ways to buy down your rate. Okay, one is a permanent buy down and one is a temporary buy down. If you check out my YouTube, we have on our YouTube channel. We just posted it. Actually, I did a testimonial last week. You might want to pull that up. I wish I should have queued it up for you. But on my website or YouTube channel, I have a testimonial on how actually a guy that we helped out, he used builder credits and he bought the house and then we refinanced him right after. He never made a payment for 5 months. It was awesome. So you can do a temporary buy down or you can do a permanent buy down. If you did the permanent buy down, absolutely, it's on there. Your rate's stuck for the entire length of that term. If you did a temporary buy down, it's only on there temporarily for whatever time frame it was. So if you need some help, reviewing that or a little bit concerned, go to, again, these are things that we can help you with. And that's what we're here for, folks. My whole goal is to help educate you guys, and then hopefully after you watch me and you maybe reach out to us, schedule a consultation, watch some of our testimonials and things like that, you'll get a feel for what we do. Cause I have a slogan you guys might not even have heard of before. It's one application, one credit pool. We're going to compare your loan to over 30 different lenders. So let me explain what I do real quick. I'm actually a mortgage loan officer. I've been a loan officer for 35 years. That's why I said I was born in 1965. So I work at a bank that allows me to have a federal license. So I'm licensed in all 50 states as well as Puerto Rico. The cool thing about the bank here is we're set up with over 30 other lenders and we can use them. So one person asked me the other day, we're like, oh, okay, we're going to use XYBZ Bank for this one because they just have better rates and better terms than us right now. And you work with us the whole time. So you don't have to go to that lender, that bank. We're there for you. So I work at a bank, But we're also associated with, say, over 30 other lenders, and that's what we're going to do. So when we get you a quote, we're going to show you how we get you quotes with over 30 different lenders. Check out yesterday's live event. I'll try to put it right up through there. And I show you basically, I pull the curtain behind the scene and just show you exactly what we do. So thanks for that. And hopefully you got that, understand that a little bit more. I have some high interest rate credit cards I might not be able to pay off for a couple years. When I refi soon, should I try to refinance in my credit card debt? That would be a great question for a consultation. Here's my question concern, I guess. We're going to have to look at it and see if it does make sense. Okay, so you're going to finance these things over 25, 30 years. So let's factor it in to say, okay, here's what your new payments would be. Do you really need it to save some money? How much is it? What's your loan to value? What's the final rate going to be? What current rate you have now? There's a lot of moving pieces to this. Would a home equity loan work better for you? Or should you consolidate it into one loan? These are all the things that we're going to offer you and just say, okay, and we're on your side. We're like, if it doesn't make any sense to do a primary loan, we're just going to say, okay, how about a home equity loan? We really don't do them. You might want to call your local bank or something, or I can even refer you to somebody. But these are the things we try to help you with. Check out earlier testimonial I did. It was a young lady I was trying to do a video with, and I couldn't get it to record. I'm like, you mind if we just go live? And she's like, sure. So we went live. It was pretty cool. So, okay, let's get some more questions. Thank you for all the great videos. I bet rates will be in the 4s by December of 2026 with the Fed continuing to cut rates through next year. Now I'm starting to understand why everybody's just sitting on the fence. Everybody thinks that rates are going to go in the 4% range. And I'm hoping with you folks, but I'll give you my thoughts here at the end of this video. And I'm going to go point by point by point, and then we're going to do a vote. Hopefully you guys can join me at the end of that vote. Okay, so what do we got here? We got Harvey. It depends on each scenario. You have to evaluate a lot of factors: cost paid, payback periods, and the net CF benefit. Exactly. Let's see what else we got. Merchants has a 5.3 there. Folks, let me do something. I don't know if I can do this behind the scenes. I'm going to pull up our how we compare over 30 different lenders, and some of these rates you guys are posted is crazy. Shoot, I got to get an access code. So as soon as I get the access code, I'll try to jump on there for you guys. But God, if you guys are getting in the low 5s with no points, let me just do this. And I was quoted in Yahoo Finance a couple years ago, and because I get these like things like this all the time. I'm not saying you're wrong, but Mr. Special Ed, and that's your name. I'd love for you to send me your loan estimate, and I'll give you a thumbs up, guy. But if you got it, I'm thumbs upping you. But I was quoted in Yahoo Finance about a year or two ago, and here was my analogy. They're like, okay, people are quoting rates at 1% or 2% when rates are like 4 and 5, kind of like that scenario. And I said, okay, here's my analogy. You know how you can go buy some gas stations and it's like, hey, gas is $1.99. I remember those days. But it was like, okay, but how so cheap? Well, you have to buy a carton of cigarettes, a case of beer, and 5 pizzas, and it's $1.99. It's kind of like how rates work. And if you go to interest rates, please, all I'm going to say is check the fine lines, because there's usually cost in there and a whole bunch of other things that you just might miss. So that's all I'm saying. I'm not saying you're wrong or right. I'm just saying be careful. That's all. So the next question that we got is, currently there is also credit unions offering 1% discount. Fantastic. Let's see the next question. Is it the credit union or a different one? Okay. Let's go. Dan, going to reach out to you soon, but do you work with down payment assistance programs in Cali? Looking at GSFA premium programs. Yes, we do have programs. Here's what I would caution you on. Watch a lot of those down payment programs. And here I'll explain to you why. This one is one of the ones we offer. There's lots of them out there. Okay, here's the problem that you face is the down payment assistance programs normally are a loan. Okay, and the bad thing is the loan, you can't refinance, you can't do anything with your primary loan without doing something about that down payment assistance. Here, I'll explain it to you. Let's say you did the loan and you got a $20,000 down payment assistance loans, and you had no money, you needed to go to closing and everything else. You bought a $200,000 home, you did put $6,000 down, so you owe $194,000. Okay, but you have a $20,000 down payment assistance loan. Now you owe $220,000. The house is worth $200,000. You can't refinance. You owe more on the house than it's worth. That's why programs like this you don't have it's not a lien on your property and there's no payments. It only give you up to $7,000, but you don't have to pay it back. So when rates go down to 4%, what everybody's saying they're going to go is you can refinance. It won't get you stuck at that moment because you're going to owe more on your house than it's worth. So be careful in that one. Should I take a loan from my 401k to make a down payment on my first condo? You guys might agree with me. You might not agree with me. So David Ramsey, I don't know what he was saying. I'm trying to watch David Ramsey a little bit right now to see what he's saying about refinancing, because some of the things he says I agree with, and others I'm like, you're crazy. But here's what I would do. The cool thing about pulling it out of your 401k, it doesn't, like on our side of the equation, on the mortgage side, we don't have to treat that as a payment because you're taking the money out of your account and you're paying yourself back. So it's not really a loan. You're just kind of loaning money to yourself and then paying it back. That's the way I would do it. That's the way a lot of people are doing it. Just be careful with your 401k. Normally you can only access about 70% of it. I check the terms of withdrawal. And if all that works out, you're in good shape. A lot of people are doing that, and we can even help you navigate through that process because a lot of people are there. Okay, so let's see what we got on the next session. What is the current 15-year fixed? Well, we do this each Wednesday. So join me next Wednesday. And here's the thing we come out. We come out and say, okay, give me this information, and I'd be more than happy to run your scenarios. Again, check out yesterday's video. Just go to YouTube. I don't know if I want to do this. Let's see. No, I'm not going to do that. Okay, let's get to the next question that we have on track here. You want to know where 15-year rates are? 5.74. Now, that is that. Okay, so let me go. Let me get my train of thought here on where, because I want to answer every question. You guys are kind enough to join me. So I am going to answer every question that I can possibly answer. So if you guys have the time, I appreciate you for being with me. Okay, so let's see. Is it right time to refinance? It's way beyond the right time to refinance a 7444. So here's the thing. Even in the most expensive parts of the country, well, let me dive down this way. You've asked the refinance question. Why haven't you done it yet? Okay, I guess that would be the first question I would have. Here's what a lot of people are seeing, and here's what we're doing with a lot of people. I don't want you to go in further in debt. That's not the goal. So if you can afford your current payment, I have a plan for you. Right now, the 15-year term that we're seeing is basically the same as a 15-year. The 20-year is the same as a 15-year. I ran a couple scenarios this week where one, I started laughing because the payment was identical to what the person was paying today. They had 28 years left on their mortgage. So we put them in a 20-year term with a 15-year rate. It was like it was way down the low in the fives. That's why I don't know how you guys are getting fives on the 30-year. God bless you. But it was perfect. So on yours, yeah, reach out to us. Here's what we're going to do. No hard pressure sales. Just call, email, text, whatever you want to do right through here. And we'll run an analysis for you, or just, email me your mortgage statement. I'll run an analysis and say, okay, here's where you are, but I need to know your zip code, your address, and things like that, because the biggest cost when you go to refinance. So if you're a homeowner right now, you're looking to refinance, when you bought the house, the closing costs are crazy. They're crazy. When you refinance, it's a fraction. A lot of people are learning that now. They're like, oh my God, if I would have known that, I would have done it before. Because it's like in Illinois, there's almost a flat title fee of like $900 if you go to refinance. Remember when you bought it, it was 5, 6, 10 grand. So it's a fraction. So don't hold it off anymore. But what we're going to do is, go through here, put in your information, ask Dan, or go through here, go to calculators, hit used in calculators, run the numbers. Should I refinance? It'll show you how much you're going to owe. Put down here, closing costs of like 3, 4 grand. And then if it works for you, call me, email me, text me. Love to help you if we can. So let's go back to those rates and let's go back to your next questions. What is the current rate on a 15-year fixed? Okay, so I'll get back to this. How interest rates work. There's factors involved. Here's the factors. There's no one like, okay, the 15-year fixed rate here is 5.74. Well, if you go to, let's do this. I did this yesterday. Mortgage rates today. Okay. Here's how confusing it is. 6 hours ago, mortgage rates today, 15-year. They're saying they are, where are they saying they are? They're saying that the 30-year right now is 6.85. On Thursday, the 27th, 6.7. Now, they are way off. Okay, so we're not going to use that. You get my point here, folks? I mean, I think that's so. You go to the next one. I'll just go to Freddie Mac mortgage rates. What do we got here? 15 years, 619. And so they're all different. Okay, because what you have to understand, this is an ad. It's an ad. Okay, this person right through here, they have a 780 credit score with a 75% loan to value, meaning they're only financing 75% of their home. This is the ideal client. Okay, so when people are like, okay, I'm getting a 30-year fixed at 5, I'm like, I don't know how, but God bless you if you are. So this is where it is. Reach out to me, follow our events on Wednesday to find out, what exactly you would qualify for, or just email me. Email me your mortgage statement, and I'll get right back with you with a quote. Hell yeah. Thanks, yeah. What rate can I get at 15-year? You're going to have to give me more information on that. Let's get to the rest of the thing. Okay, let's see what we got. I am currently on 5 for 15 years. God bless you. Keep it. Don't look back. Maybe you can get 4 something. It's not worth the cost, folks. Hey, that's what my son always says. Every time I text him something, he's like, hey. Okay, so let's see what we got here. Any chance it will go below 4? That's what I'm asking you guys today. So I need you guys to start chiming in. Where are we going to be at the end of the year? Where are we going to be? Are we going to be, I'll just make it simple. Are we going to be at 599? Right around there. Give or take a quarter. Thumbs up, thumbs down. Okay, I'm going to keep answering questions. If you don't give me a thumbs up, thumbs down, I'm not going to answer any more questions. No, I get it. Any chance it will go below 4 for the 15? It could. Yeah, because if usually the 15-year is, there sometimes there's big spreads, sometimes there's little spreads. Just, keep an eye on it. Again, that's another reason why I'll keep peddling this thing. Or go to the rate update. Okay, here's the tool for you, RateWatch 2.0. If you're a homeowner, click this button right through here. Give me your mortgage info. I don't sell it. I monitor this daily. So yesterday we reached out to 29 people. 29 people. We called, text, and emailed. Congratulations, your RateWatch just triggered because they put this information in previously. We're monitoring rates for you. So if you want us to monitor it, put your information in here. If you think it's a good time, especially if you're over 7. If you're over 7 now, just as soon as the video's over, call or email me, please. Okay, that's all I'm going to say there. Let's get to the next one that we have. Anyone guess? But I think it will drop below 4 if we have the QE from the Federal Reserve and they drop the federal funds rate to 2. Yeah, we could. This is going to be sarcastic, so take it as a joke. Okay, so if we have QE, which we're not, the Federal Reserve, and they drop the federal funds rate down to 2.5, they're not. Okay, so if they do all that, I'm in agreement with you. We're going to get down. We're not going to go below 4. Okay, we're not going below 4, folks. Okay, so if you think that and that's what you're thinking, good luck. Never in history, I can probably say. Let's go back to my thing, our chart. Other than that time frame in history, is the only point in history that we went below 4. So if you think we're going to get there, I won't even comment. I'm waiting. Okay, you're not going to get QE, folks. You're not going to get QE. Okay, I see the problem. I see the problem. A lot of you are younger, and your norm rate is 3-4%. That's not the norm rate. The norm rate in economics and in the economy, probably mid 5s and higher. Okay, and you can see it right on the chart here. Right through here. 5% and higher, that was history. That was forever. All this data up through here. One little tiny spot in history, we were in the below 4. We're not going to get there. Here's what occurred. The world shut down. So let me go off to, I'm going to answer a few more of these and then I'll go on and conclude. Let's see, any chance to bump and low of 15 going from here? Let's see what we got here. This one looks like a good one, going from 6.8. Fantastic, to 5.99, buying down a quarter. We'll do the next one when we get in the low 6s. Perfect. And I hopefully you reached out to us. If you haven't, Abdul, send me your loan estimate. Okay, so if you're in the process of refinancing right now, Folks, I'm not trying to steal business from anybody. If you watch some videos, especially VA clients right now, they're getting hosed. VA clients are getting hosed. If you know a veteran, please send this out to them. If you're looking to refinance, don't go to your current mortgage company, especially if they're one of the big servicers or one of those big VA places. They're killing you guys, especially if you have a credit score under like 620. They're saying, oh, you can't get this loan done. Nobody's going to do it for you. I can guarantee you, if they're getting it done, we can get it done. Okay, reach out to me. Give me some quotes. I just left a bank and I just watched a video from a huge YouTuber. You guys probably see her, and she was talking about VA clients getting just abused. I'm going to have to jump on her bandwagon. I just left a company, and that was one of the reasons why. They were taking advantage of people is the only thing I want to say about that. I don't want to get into any troubles or anything else like that. I didn't like how they were doing things, and her video kind of reaffirmed that today. So if you're a veteran out there, the whole goal why I do this, folks, is we're trying to keep people in check. If you're a mortgage loan officer out there, I'm not your threat, folks. My whole goal is to help you out. I'm trying to weed out all these people, especially homeowners, home buyers getting taken advantage of. So if you think you're getting taken advantage of, now if you got 5, 6, 7 different quotes, folks, just stay with them. I'm not a miracle worker, and we're extremely busy. But if you think you're really out of whack, you're getting a quote at in the sevens still with fees, reach out to me. Because what they're doing is they're saying you don't really have any options. We're your servicer. It's the best way. I've made an exception for you. They didn't make an exception. If they got your loan approved, in most cases, I'll say 95% chance of the cases, I'll get it approved unless they did fraud. So if they're telling you you're stuck, you have no options, please call me, text me, email me, reach out to us, and we'll help you in any way we can. My whole goal is education. I'm here to educate and help be there when you need it. We had a young lady this morning that I did a testimonial for and with. She was in a really bad spot. She went in and rehabbed a house. She fixed it up. The builder then, or the seller came back and said, we're not going to sell it to you. There was legal actions. We stayed with her the whole time, and it just recently closed, and she's happy as a lark. So that's what we're here for. We're here to help you. I'm not here to take advantage of you. We're here to help. So if you're out there and you have a loan estimate, okay, send it to us right through here. It's a loan estimate review. We just want to make sure your loan estimate's in check. Now, if we're saving you $500 or something like that, please use your current loan officer. They did their job. They worked hard to get you to this point. But if you're a loan officer and you just gouge somebody and you charge them points on top of it, just trying to make a huge paycheck for this month, you guys are the ones we're trying to reach out for, or those companies just hosing these people. So send us your loan estimates. So let me conclude with this. I'm going to go over what my disposition is. Okay, so here, I'll get to this last one. Does shopping hurt credit? Let's say I apply with you to shop your lenders, but also I shop with a couple other I choose. Does my credit score? No. Once we pull your credit, or anybody pulls your credit for 45 days, you're not going to get affected. Okay. The other piece of that is a lot of people are like, don't pull hard credit. I'm not going to go, if you're going to pull hard credit, you have to get a hard credit. The only way to get it truly approved is to have your hard credit pulled. Okay. It'll affect you up to 5 points. 5 points. I confirmed it with every credit agency. Normally you're going to see about 3, maybe, but for 45 days, you're good. So it doesn't matter if you have 20 people, give you quotes. Please don't send it to me if you're getting 20 different quotes. That's what we're here for. I'm here to do that due diligence for you. Join us Wednesday. You can see how it works. So let me get you my thoughts on this. I'm just going to finish it up here. Here's what rates have been over history, folks. Okay, and I've been alive for all this and been in the markets. And I was here, and I was in here. This was normal times. This was normal times. This is before the pandemic, before the crash and everything else. If you can get rates right down in here, fantastic. Okay. Yeah. Rates are a little bit high right now, but I'm thinking, if we can get into this, mid, low 6s, high 5s, historically, that's great rate. The only thing that would push us below, into the 4s or lower is catastrophic events. And we're not in one right now. Yes, the world is crazy. You have all these wars and everything else. But the economic environment right now, you watch Wall Street hitting record highs every day, and they don't know what's going to come down the pike. But these are just my analysis. I might be wrong, but I'm not going to come on here every day and tell you you're stupid or you don't know what you're doing, folks. I'm not an advisor. I'm not a CPA. I'm not what some of these people say they are. I'm just an average mortgage guy that's been doing this a long time, and I can read the markets and I can at least give you some advice on what happened in the past. So if you're waiting for rates to get in the 4s, don't sit on there, especially if you're in the sevens. So that's what my expectations are. I'm thinking things are going to ease back. The biggest thing I want you guys to focus in on right now, the CPI is going to come in tomorrow. That will give us some short-term, bumps in the road. Check and make sure the tariffs are deemed legal. If they're not, all bets are off. Okay, the tariffs have to come back legal. Government comes back to action. We're then going to get all the financial news we need and are going to get. I think the job market, you're going to see deteriorations there. I think the tariffs and inflation is not going to be as bad as a lot of people think. One big thing is the housing equivalent rents are down to a 15-year low. We got oil also down right about $60 a barrel. That's going to help inflation huge. Could that offset tariffs? I don't know. Tomorrow, we're going to get the CPI number. We're going to see how that comes out. And that is going to set the tone. But right now, I think a lot of traders are getting just in a position for some bad news tomorrow. So you have the MBS is down 21. That means rates they're going up. And look, we gave up all these gains. So one last conclusion here. This is the bond market. I'm not trying to teach you the bond market. When the price goes up, rates are coming down. When they go down, rates are going up. Here's where that move where we're trying to get a lot of people to lock in. I don't know where the rates are going to go from here. Are they going to get to 4? In my opinion, no, folks. Sorry, but I hope they do for your case. I hope they do for home buyers and homeowners. And if they do, I'm here for you, and we'll be busy as all get out. So, folks, my name is Dan Frio. My whole goal is to help you understand what is going on with these and the whys behind it. So thank you so much for joining me today. I will not be doing a closing bell. I'll be back tomorrow at the opening bell. Once the CPI gets posted, I'm going to wait for tomorrow's video or CPI report to come out. Then I'll post and show you instant reactions to that. I'm not thinking it's going to be good news, but I hope I'm wrong. So thanks for joining me. Thanks for participating today. And I hope you guys continue to watch and subscribe right over there. We're almost at 40,000 subscribers. If